Hi, welcome to the next episode of Excelia EduServices. Today, we are going to talk about the basics of the capital asset pricing method or the CAPM model. Well, before we get into it, let's understand why is the CAPM model used for or where is it used for. So, investors, as you know, want to reduce their risk and they do so by taking the advantage of diversification and having a portfolio of investments. Now, in order to measure how a particular security contributes to the risk and return of the diversified portfolio is why we make use of the capital asset pricing method. The capital asset pricing method is based on the idea that the investor must be compensated for the investment that he or she is doing in two ways. One is the time value of money and second is the risk that he or she is taking. On the basis of this, we derive the formula for the CAPM model, which is the required rate of return is equal to RF plus beta multiplied by RM minus RF, where RF is equal to the risk-free rate, the rate which you as an investor would get by investing in one of the safest securities, probably like the US Treasury bills. RM refers to the market rate or the rate which you as an investor would get by investing the same amount in the market. The next term is the beta. What does beta refer to? Beta measures the systematic risk or the volatility of the individual security in comparison to the market. Also, the RM minus RF in the CAPM formula refers to the market risk premium. What do you mean by the market risk premium? It is the amount that you as an investor are getting over and above the risk-free rate for investing in the market security and taking the risk associated with that security to earn that additional return. So the additional return that you are getting over and above the risk-free rate is called as the market risk premium, which is also calculated by the formula RM minus RF, or in other words, the market rate of return minus the risk-free rate of return. Now let's look at a diagrammatic representation of the CAPM formula, where we have in this diagram we have the x and the y axis, where the x axis denotes the systematic risk or the beta, and the y axis talks to us about the expected rate of return of an investment. We also have the red line that you see is called as the SML or the security market line, which is a combination of both your systematic risk and the expected rate of return. So now let's understand that you as an investor, we say you would at least be getting the risk-free rate by investing in the safest securities in the market like the US Treasury bills. So this, if I denote it, if you look at the dotted lines, so this part of the returns that you are getting, the expected rate of return, is called as the risk-free rate. Now, if you invest in the market securities rather than investing in the risk-free securities, you would be getting a return which is going to give you a return of RM, which is out here. So you are going to get, if I connect the x and the y axis, you are going to get a return which is to this amount rather than getting a return which is denoted at this amount, this level. The additional returns that you are getting over and above the risk-free rate is referred to as the risk premium. So your expected rate of return is a combination of the risk-free rate plus the risk premium in product with the beta or the SML. So your CAPM formula is equal to the risk-free rate plus beta multiplied by RM minus RF, which is also your market risk premium. Thank you so much. Hope you've enjoyed the video. Also, don't forget to follow us, subscribe for more videos.